Welcome to the video. Today we're unpacking the hidden blind spots that often affect people with high assets but unstable income. Think freelancers, contractors, creators, and gig economy pros. We'll offer a practical, step-by-step plan to create true long-term security, not just short-term survival. Let's get started. In this agenda, we will first identify why retirement security is often the missing piece. Next, we will address how to optimize assets and debt. Then we will build a cash flow system for feast or famine income. After that, we will separate passive income myths from measured risk. We will then discuss career adaptation in the AI era. Finally, we will provide a concrete action plan and check your understanding with quick quizzes. This video is for mid-career professionals with uneven income who have built assets and minimized debt but may not have built a dedicated retirement plan. That sounds like you? You're in the right place. Before we proceed, this video is for educational purposes only. It is not financial, legal, or tax advice. Always consult with a licensed professional who understands your personal circumstances before taking action. Transitioning to our core issue, the most common blind spot is a lack of dedicated retirement accounts. Even if you have strong assets and cash reserves, relying exclusively on Social Security is risky, particularly if your earnings history includes significant 1099 or contract income. The priority move is to maximize contributions to tax-advantaged retirement accounts, such as a Roth IRA, within IRS limits, and to do so annually for both partners if applicable. The tax-free growth and compounding effect here create wealth that active labor cannot match. The end goal is an income stream that does not depend on your physical ability to work. Next, let's refine your assets and debt. A rental property can be an excellent asset because of its cash flow. Evaluate the mortgage rate on that rental. If the rate is relatively high, accelerating the payoff can materially increase your net passive income. Conversely, do not leverage the equity in your primary residence to fund speculative investments. Finally, clear small consumer debts quickly, such as a car loan, to reduce financial complexity and free up monthly cash flow for investing. Now, let's build a system for uneven income. First, target at least 12 months of expenses in your emergency fund to handle slow periods. Second, automate transfers during high-income months so that your savings and investing occur without relying on willpower. Third, follow a consistent sequence for surplus dollars. Top up the emergency fund, eliminate high-interest debt, maximize retirement contributions, invest in a total market index fund, and then consider prepaying the rental mortgage only if the after-tax return is favorable compared to alternative investments. To visualize the cycle, during high-income periods, invoice efficiently. Allocate to your emergency fund, debt, and retirement accounts, and automate transfers. During low-income periods, reduce discretionary spending. Use the emergency fund as a buffer, and invest time in upskilling and business development so the next high-income period arrives sooner and stronger. Shifting to expectations, passive income is rarely effortless. Real estate brings management and risk. High-risk assets such as cryptocurrencies or NFTs are speculative and are not suitable for those prioritizing stability. Instead, adopt measured risk by investing excess funds in diversified, low-cost, total market index funds. This approach allows compounding to work around the clock while you focus on life and work. On the left, we have the myths: the allure of easy passive income, high-fee concentrated bets, speculative assets like cryptocurrencies or NFTs, and leveraging your primary residence to invest in risky assets. On the right, we have measured approaches: using diversified index funds, automating contributions through dollar-cost averaging, aligning risk with your goals and time horizon, and keeping a robust emergency fund as your shock absorber. Regarding career risk, do not abandon your creative skills. Adapt them. Build a niche where your human judgment directs automation. Examples include prompt engineering, data training, ethical design, and workflow automation. Package your expertise as retainers, workshops, or consulting. Create proof with small pilot projects and micro-credentials to quickly demonstrate capability. Here is a sample surplus allocation to illustrate priorities. First, retirement accounts to capture tax advantages and compounding. Second, emergency fund top-ups to maintain a 12-month buffer. Third, a taxable index fund for flexible, diversified growth. Finally, an upskilling budget to protect and expand your earning power. This is only an example. Tailor your allocation to your goals, tax situation, and interest rate environment. To execute, begin with an audit of your net worth, debts, interest rates, cash flow, and the number of months covered by your emergency fund. Next, open or verify your Roth IRA and set automatic contributions subject to annual limits. Eliminate small consumer debts and evaluate whether to refinance or accelerate payoff of a high-rate rental mortgage. Then, implement automation rules for high-income months, sequencing funds to the emergency fund, debt, retirement accounts, a diversified index fund, and finally, optional rental prepayments. Build an AI-era portfolio update and produce one pilot project. Launch a retainer or workshop offering, and conduct consistent outreach. At the 60 to 90-day mark, review and rebalance, increasing automation amounts after each high-income month. Revisit your assumptions quarterly. This table summarizes 4 core accounts. A Roth IRA uses after-tax contributions, but growth and qualified withdrawals are tax-free, making it excellent for long-term retirements. Traditional IRAs and 401(k)s typically allow pre-tax contributions with taxation at withdrawal. Some 401(k)s offer employer matches. A taxable brokerage account provides flexibility for investing after tax-advantaged accounts are funded. A high-yield savings account is best for your emergency fund because of liquidity and capital preservation. Quiz time. The question is, what is the most common financial gap for high-asset, low-stability professionals? The options are A. Not enough cash savings. B. Lack of dedicated retirement accounts. C. Too many real estate properties. D. Insufficient credit card reward strategy. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is lack of dedicated retirement accounts. These accounts provide tax advantages and compounding that create income streams independent of your ability to work. Second quiz. The question is, during a high-income month, which sequence best aligns with the system we discussed? The options are A. Invest in crypto, then upgrade your car, then save what's left. B. Max out retirement, then emergency fund, then pay high-interest debt. C. Emergency fund top-up, pay high-interest debt, maximize retirement, then broad index fund. D. Borrow against your home to invest in speculative assets. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is to top up the emergency fund, pay down high-interest debt, maximize retirement contributions, and then invest in a broad market index fund. This order prioritizes resilience and then long-term growth. Here are the key points. Prioritize retirement accounts. Maintain at least 12 months of expenses in your emergency fund. Optimize your rental mortgage and eliminate small debts. Avoid speculative investments and do not leverage your primary residence to take risky bets. Use diversified, low-cost index funds for steady growth. And adapt your creative skills to the AI era to preserve and expand your income. To wrap up, keep your present secure with cash reserves and debt discipline, and secure your future with dedicated retirement accounts. Automate your system so progress continues through income volatility. Invest using measured risk, and let compounding do the heavy lifting. Continue evolving your skills so your income remains valuable in the age of AI. Thank you for watching. If this video helped you, please like, share, and subscribe. In the comments, share your questions and your next 90-day financial goal. Let's build smarter wealth together.